All right. Good evening, everybody. Hope you had your dinner. And if you haven't had your dinner, you can also have a dinner while chit-chatting with us also. Well, welcome. Thanks for joining us tonight in our Investors Coffee Time at 8 p.m. And today we're going to talk about how to avoid value traps, right? Because the market has provided quite a number of opportunities over the past 1 month. And of course, we have seen some technical rebound as well. But in the long term, there's still quite a number of opportunities. Prices are quite low. And I think there are a lot of questions from you guys as well, whether, with the current prices that these companies are offering right now, whether they provide any value traps or not, right? It's like basically trying to buy a car when the price is so cheap, right? And only to find out later that the car has many problems. So how are we going to avoid, right? Finding a company, right, which provide that kind of really good value currently, right? And how do you actually identify them so that they too can actually unlock their opportunities, being to unlock their value as well. Okay, so that's what we're gonna talk about today, right? And of course, Peter Lim is gonna be the main star today. He's gonna share with us, right? Being a fund manager, I think that's quite important, isn't it? Trying to actually avoid so-called value traps.
Yeah, it is.
All right, so we wanna pick his brain today, lah. All right. So, before we start, for those who are new to us, we have our coffee time every single night at 8 p.m. So hopefully that you are able to continue to join us, because in Equities Tracker we are still working from home, right? We haven't gone to the office yet, so keep us company as well. We'll be able to share with you more information, right, for you to become a well-informed investor. So we'll try to bring in more contents for you guys as well. And hopefully that you're able to also share this with your friends on your Facebook page so that they too can also benefit from this. All right. So, but before we start, please note that the content of our discussion today does not constitute any investment advice. It's for educational and informational purposes only. Right. So, if you want to buy shares or any investment products or services, you want to find or ask for advice, it's better to look for a qualified and licensed investment professional. All right. So, hopefully they are able to share with us. Our coffee time is held every night at 8 p.m. So tonight about how to avoid value traps. Okay. So for you to get notification from our pages, please like our page and also follow us. Right? Because some of you liked our page but did not follow us. You don't get notifications when our live session is on. Right. So please follow us and also make sure that your notification is on for our Equities Tracker page. Okay. And for those who are viewing it from YouTube, because we also stream this live on YouTube, please subscribe to our YouTube page, and that's Equities Tracker. Right. So all you need to do is subscribe, and once you subscribe, you're able to get notifications from us. All right. Okay. So right now, basically, I'm gonna get Peter on. Maybe he will first of all explain to us what really is a value trap. For the benefit of those who are still new in investing. Right, Peter, maybe we can explain first.
Yeah. Okay. Hi. I think generally what we mean by value trap is if you found a company where you find that it's undervalued, right, and you started to invest in it. So what happened is, what if the company's value remains hidden, in the sense, or the share price didn't react to the perceived value that you think it is for a very long time? Maybe we talk about 1 year, 2 year, 3 year, or even for quite a long period. Meaning to say the perceived value which you value the company and which you make your decision on, it didn't materialize for a very long time. So that means what you're trying to say is that the value remains hidden for a long period of time. There are a few categories, a very broad category. I mean, this is purely how I view it. It is my opinion. Broad categories of areas of stocks where you can have a lot of such situation. Number one, I would say they are mainly conglomerates. Conglomerates, mean to say, is actually a company where they have multiple businesses, multiple subsidiaries. A very good example, like formerly, what you have to like, I was asked actually about 𝑘𝐯𝑚 before. I think look at 𝑘𝐯𝑚, right? They have multiple businesses. They have property division, they have hotel division, they have your BHP petrol kiosk is also theirs. Your Jotun paint is also theirs, right? So they have a lot of multiple type of businesses under that's conglomerate. You also have things formerly it was things like 𝑠𝒓𝒊𝒕𝒚. There is also a conglomerate. Of course, subsequently they actually listed subsidiary actually unlock the whole thing. So these are what we mean by conglomerate. DRB HighCom is another very good example of a conglomerate. So what if you look at a lot of analysis or a lot of analysts, what they will say is for conglomerates, right? They will actually use what we call as a sum of parts to actually value the company. Mean to say sum of parts is if you go back to the example say of or even also even DRB, right? What they would do is you look at DRB, they own companies like Alam Flora. They also own your car vehicle inspection 𝑃𝒓𝒊𝒕𝒚. They also own the military vehicle manufacturing, which is DevTech or defense technology. They also, of course, they also own Proton, right? So I mean, these are some of the big ones that they own, but they have hundreds of subsidiaries. So what analysts will usually do is they will try to value each part of the business. They come up with the value of the part of the business, and then they add everything together to form the whole value of the company. Take, for instance, what they'll try to do is they'll value DRB again, for instance, they try to value how much is Proton worth as a business. Then they'll try to value how much is the property division of DRB is worth, how much 𝑃𝒓𝒊𝒕𝒚 is worth, how much Alam Flora is worth, and then they add together and then they get a DRB. So this is where the tricky part is. If you look at it, right, the reality is wherever you try to do that, you get a very, very big number compared with that where the share price is. The sum of part value will always be much higher than the share price. So I guess a lot of investors will get caught into this. It's a very easy sell for analysts. It's very easy for them to convince because you just add everything. Okay, this is what the whole value is going to be. And then they will tell you, compare with the share price now, no, this is undervalued, it's very cheap. You should buy. But let me tell you, the reality is this. You wouldn't see any conglomerate that trades at the sum of part value. It is not going to happen, right? So that's why this is one of the most common value trap that I think a lot of investors got caught, where they think that, okay, when I look at the sum of parts, is this, whereas individual is this. Why so? I think one of the reasons is, see, sum of part valuation only works when there is a breakup or when there is a liquidation, right? When they start to liquidate, then only individual value of each businesses makes sense or is relevant. As long as the whole entity continue to exist as a conglomerate, there's really no breakup value and there's really no point for you to count what is the individual business value than what is as a totality. So to me, this is one of the most common value trap that I've seen. People try to work out on conglomerate, they add this the value, they invest on it, and then they sit and wait and nothing happens, right? And I must say, the only way where you will really value be uncovered is when there is a breakup. And that's exactly what 𝑠𝒓𝒊𝒕𝒚 tried to do. So when there is a breakup, that is where the individual value emerge. That's why you look at a lot of activist investors in the US. What they will actually do is they'll actually buy a stake in the company and they'll actually force the company to actually break up so that to unlock the value. So until then, right, if a conglomerate maintains as a business as usual, that there is no restructuring or there's no breakup value, you're likely going to be caught for a long time. Yeah, and bear in mind the price on average, right? The price versus the sum of parts, we call SOP, it can be as big as 50% discount. Yeah. No, I just saw a very funny message. No, I just got a friend just texted me. Don't share the secret of analysts.
Don't share the secret of analysts. I mean, that's why
sorry.
Well, you guys actually coming here because you are really cracking a heel of a fund manager right now. All right.
I'm telling you all the trade secrets of analysts. Sorry about that.
Yeah, that's how we make our investment decision, right? Okay, so there's a question here, Peter. Is Berjaya Food considered as a conglomerate in this case?
No. See, Berjaya Group is a conglomerate, right? Berjaya Group, you see, you have Berjaya Food. You have they used to own Burmaz, but they still own a minority stake in Burmaz, the automotive division of Mazda. They also own Berjaya Hotel. They also own education arm, Berjaya Hospitality. They also own Causeway. They also own 7-Eleven. They also own properties. I mean, that is a conglomerate. But Berjaya Food is a part of conglomerate. Berjaya Food is more focused. It is mainly food businesses. So it is not diversified. So if you have multiple brands under it, of course you have Kenny Rogers and you have Starbucks, but that doesn't make it as a conglomerate. It is not diversified because you're still focusing on food, just different brands. Yeah.
So is there a formula? For example, there are companies that maybe, although they are diversified, they maybe have like 2 or 3 business units, but maybe one of the business unit is actually holds much more weight than the others. Could it be a conglomerate as well?
It's very subjective to actually define that. There's really no cutting point value of what is actually a conglomerate and what actually not a conglomerate. If say for instance, right, let's get a very extreme example, right? Say for instance, if this company got say 10 businesses, but one of the businesses contributes say 80 or 90% of the profit, that is really not a conglomerate because it is the one single. You're actually looking at the company as a one single company, one single business, because that business is so substantial that it contributes say 80 to 90%. But if say for instance, if the biggest business within the 10 subsidiary, say for instance, ballpark contributes 20 to 30%, and you still have another 70% coming from other businesses, then to a certain extent, you may say that to a certain extent, it is a conglomerate in that sense. Yeah. So that's the first category of where investors can be caught in terms of the value trap. The second most common value trap is actually property companies. It's actually a value trap on the basis. Again, if you look at see, when you look at property companies, you realize analysts don't usually use PE to value property companies, right? They actually tell you how much is the discount to the net asset value or RNAV. Okay, there is 2 valuation where analysts will tell you that property companies, either they are selling the share price compared with the net asset value, how much a discount it is, or if they are more aggressive, what they will do is they'll use the discount between the share price to the revalued net asset value or realized net asset value, whatever the R you call it. The main difference is when I talk about net asset value, they will actually value the value of the land bank that this company have, and they will compare with the current share price, and what is the discount? How low is this company's current market cap compared with the value of the land bank? If they are more aggressive, what the analysts will do is they'll try to project the value of this land bank at the current price or even at the future price, factoring, okay, if this land is being developed with this commercial value, how much is it, right? That's where it's the RNAV comes in. So they say, okay, this share price is here, the RNAV is here, so therefore it's a big discount, you should buy. Why I say this is a second value trap is because, like it or not, all property companies trade at a discount to NAV. It's just a norm. The only difference is how big is the discount. So you take a ballpark average, right? Even your giants, right? You talk about the big companies, the big property companies that you know of, companies like your Masing, your 𝑠𝒣𝒊𝒕𝒚 is a rarity. It's a bit of the outlier. But all your big property guys, right? Usually they trade around plus minus 30% discount to NAV. If you're a secondary, like a second tier, a smaller company or small property companies, right? Don't be surprised if we trade at a 50% discount to NAV. It is the nature of the valuation. So again, why I say it's a value trap, because a lot of investors, when analysts actually send a report, hey, this company trade at 50% discount to NAV, it's so cheap, and people actually rush to buy. I think people don't really understand the fact that is the reality of the market, that there's nothing surprising for a property company to trade at such a big discount to NAV. So it doesn't mean when trade at 50%, you should jump in and buy, because everybody else is trading at about the same, right? Even the big guys average is 30%. Why I say 𝑠𝒣𝒊𝒕𝒚 is a rarity is because when it's still under Tan Sri, the previous Tan Sri, right? 𝑠𝒣𝒊𝒕𝒚 is a very rare company, but I think it's the only property company that actually trades at premium to NAV. It is the only one. So even when PNB took over the stake from Tan Sri Leong, they actually bought at a premium to NAV. So it is one of those very, very rare cases. I guess one of the reasons why 𝑠𝒣𝒊𝒕𝒚 has such able to command a premium is because they really built a very good reputation in the quality of their projects. I mean, if you look at it, all their property are selling actually at a premium because they really prove themselves in terms of the quality, the execution. All their different projects under the previous administration is all hit, like your EcoWorld, your EcoCity, those it is a very well-run mansion. So that is an outlier. But other than 𝑠𝒊𝒕𝒚, it is a value trap if you try to jump in simply because it's trading at a discount to NAV. The third category of a value trap, this is a bit.
Okay. Maybe before we go on, maybe try to answer some questions first. So the first one is basically conglomerates, right? Because it's really difficult to determine the value because they are all like consolidated into one. There's a follow-up question to this. Like for example, Hong Leong Industries, is it considered as a conglomerate? This is a question from Jeffrey Ong.
Hong Leong Industry was a conglomerate, but what they did was few years ago, I think plus minus, let me pinpoint, maybe 5 years ago, 2015 plus minus, right? Hong Leong Industry actually underwent a restructuring. You look at it, so what they did was they used to own Hume Cement was actually part of Hong Leong Industry. They have three core businesses, Hume, which is cement. They have one small fiber board operation. It's a fiber board, those you think of the ceiling. And they have a Yamaha motorcycle division. So it's combined. So what they did in plus minus 2015, you have to check the record. My memory is around 2015. Plus minus 1 year. So what they did was they undergo this restructuring where they actually carved out Hume Industries to become a standalone listed company. And the Hong Leong Industry remains its motorcycle and fiberboard. Don't ask me why they maintain the fiberboard inside. It's exactly the same question I asked the management and they can't answer me. Just like, it makes sense. I mean, you should have just packed the fiberboard together with the cement. It makes more sense. But somehow, I don't know what runs in their mind. So they actually did maintain the fiber. But of course, the big bulk of Hong Leong Industries still come from the motorbike. So would I say Hong Leong Industry now is a conglomerate? I would say no, simply because all the earnings are actually coming from, or the big chunk of earnings actually coming from motorbike division. So Hong Leong Industry now is actually much more of a consumer in the sense, if you think motorbike or if you classify motorbike as a consumer, and that is what I mentioned, right? See, if you look at the returns of Hong Leong Industry before the carve out or the diversification or divestment of, of the split of the cement, right? This is what I meant by value unlocking exercise. Before that, Hong Leong Industries, the share performance was actually so-so. Nobody really appreciated as a conglomerate. But once they carve out the cement, when they reposition themselves as a motorbike player or Yamaha player, right? The whole chart just rallied. To be honest, it's one of those very painful stocks which I miss during that time. If you ask me what one of the stock that I've missed and it's very, very painful, Hong Leong Industries is one of them. And why is it so painful is because I take scooters to work, and coming from someone who takes scooters and ride a Yamaha, yet I didn't even notice to buy the company. I bought the bike instead of the company, so it's one of those very, very painful experiences. Yeah.
All right. So now there's another question here from Yin MK. So in this case, for newbies, is it better to find manufacturing companies to analyze rather than conglomerates, which may be a little bit more difficult to analyze?
I would say so. I think for anybody who want to start their first few analysis or to try out how to analyze companies, right? It's always good to start with something you can see. You can actually observe, you can see, you can monitor. Things that are more visual. Say for instance, manufacturing. That's why I say in the industry, right? Whenever there's a new analyst that joins a company, it is quite a quote unquote industry practice, right? We always give them consumer. It somehow is as a stepping stone. But then you see, why consumer? It's simply because it's things you can observe. You can walk into the supermarket or your modern trade or traditional trade. You just look whether it's a product there. Is it a brand name that it's a much easier thing to analyze. So I would say yes, if you're just starting on analysis, I think manufacturing is a better first step towards that. Yeah.
So it's like Warren Buffett, like you only invest in company that he can understand, and it is simple, it's easy.
Yeah, correct.
So the second part,
I can start with the third one. The last one where I think what is actually the value trap. This one
Oops, Peter, I think I'm losing you. Can you hear me, Peter? The third and the last one. We're all waiting for him and he's being cut off. Okay, hold on for a while. Okay, see what's happening. Hello, Peter, you right? All right, I think I've just lost Peter. I'm not sure what's happening now. Peter is meditating. Okay, he's coming back. Just hold on for a while. Yep. Peter, are you okay? You were cut off just now. That's why we need the 5G. Uh, yeah, 5G or not, I think it's also the service. Although, like my place there, I got this 500 MB of data, but you don't really get the full 500 also. So it depends on the service, right? Okay, Peter is back, but hold on, guys. Okay, well, we are waiting for Peter to come back. Let's make some announcements before we go, before we proceed. So again, for those who have not liked our Facebook page, please like our Facebook page and follow us so that you can get notifications from our live sessions. All right. So please like and follow us on our Equities Tracker Facebook page. And secondly, you can also subscribe to our YouTube channel if you are more used to having YouTube to view the live sessions. So please go to Equities Tracker YouTube channel and subscribe to us. All right. For those who have not tried or access to our Equities Tracker platform, we are actually offering a 2 weeks free access to Equities Tracker platform. And this is where you are able to actually look at financials of companies historically as well, right? And it gets updated on a quarterly basis so that for you to do an analysis on the company based on fundamental analysis, all right? So you can WhatsApp us at 603-8408-2070, and you just follow the instructions on the WhatsApp chat, and then you should be able to access our Equities Tracker platform for 2 weeks. All right. Now we also have run this charity effort to actually help those who are in need currently, especially during this MCO time. So what we are actually offering is for those who donate, we're going to give a free access to our online courses, all right, which we call the ET Online Campus. So all you need to do is to donate a minimum of 100 ringgit. Okay, and once you have donated 100 ringgit, please keep the receipt. You can donate to any charity, right? If you do not know which charity to donate to, you can log on to charity.equitiestracker.com. That will give you a few suggestions, right? And to also register for the ET Online Campus, where you get our online courses, and which we also do mentoring once a week. Like for example, yesterday Alvin was there at 10 p.m. to actually answer questions for those who have actually attended our online courses. So no, it's not just tutorials that you can see there. You also have a chance to interact with us on a weekly basis. And for those who are into the price chart analysis, tonight I will be there at 10 p.m. So hopefully you are able to join me as well at 10 p.m. at ET Online Campus. So for those who haven't joined, please join us. Just make a 100 ringgit donation, and you can bring 3 friends, all right, to also join our ET Online Campus. Okay, so just go to charity.equitiestracker.com. Okay, so far the number of people who have actually attended our our ET Online campus is almost 2,000 people, and the number of donations that you guys have donated, and those who have actually attended, right, is currently 144,500 ringgit, okay, which is almost it's like 58% from the target that we wanted to achieve, which is 250,000. So I hope that join us, right, do something good for the community, and also at the same time equip yourself with the skills and knowledge to invest. All right, so this is a very good chance for you to actually learn, and there are video tutorials in there. There are also how to use the software, how to use the platform, so that you are able to have a good start being a well-informed investor. All right, so again, go to charity.equitystriker.com. Okay, Peter, I believe you're back.
Yeah, I'm back. Actually, it's not DJ's problem, but it's Telecom's problem.
Telecom.
In fact, now I'm using DG.
All right. Okay, so you were talking about the third point right now.
Yeah, I think maybe something sensitive, so I think they decided to cut me off. The third point is actually a value trap, which is quite unfair to say. It's hard to give a term to it, but I would say generally, let me find an appropriate term. I would say legacy companies, right, tend to be a value trap. What do I mean by legacy? Mean to say companies that have existed for quite a long time, and it is still run by the family itself. That also, to me, to a certain extent, it is a value trap. One very good example is, of course, we talk about which was privatized now, or was actually Selangor Properties. For those who remember Selangor Properties, right, they were actually a developer of the Damansara area. So when it was still listed, even as way back as 2002, 2003, right, Selangor's Properties, one land bank, one small parcel of land bank in Damansara is actually much more than the whole market cap of the company itself. So if you ask anybody who actually look through the annual report, it was a very simple conclusion that the company was actually extremely undervalued. Imagine just one land bank of the many that they have is already worth much more than the market cap. But the thing is, while it was listed, right, there is really no intention of the company to unlock the value. I mean to say they were actually not very aggressive in developing the land bank that they have. They take their time. You don't see a very aggressive value unlocking or to uncover the value of the company. And how should I put it? Conveniently, it was actually privatized at quite a very undervalued price as well. So for investors who actually went into Selangor Properties that time to actually hoping to earn for an unlocking exercise, it didn't really happen. I think another company where you can say that there is a value trap to a certain extent, actually Oriental Holdings, the company that actually owns the distributorship of Honda vehicles in Singapore and dealership in Malaysia. Distributorship and dealership are very, very different. They own the dealership in Malaysia, but they own distributorship in Brunei and Singapore. They also own plantation assets. It was actually by the late Boon Siew. It was owned by the late Boon Siew company. Again, massive cash inside, very profitable businesses, very undervalued. But again, there is really not much intention of them to actually unlock the value. On the other hand, companies who are more keen to actually unlock values are actually companies that run by professional managers. There are pros and there are cons. I mean, there are pros and there are cons, right? Because professional managers, they are not the owners, and they want to prove themselves in a very short period because the compensation is linked to the performance, right? So they were actually trying their best at the shortest time possible to actually make the share price go higher to a certain extent. So this professional management are generally more keen on actually unlocking assets or doing restructuring of the whole company, hoping that the whole value would go up. I'm not saying it's a good thing or a bad thing. Most of the time, for a short period, it is a good thing. We can see the value of the broken up company on us add together is actually worth much more than individually. But they could have long-term damage to the business dynamic of it. So it doesn't mean it's always a good thing to do a breakout. I think one very good example, which again is a personal view, people may agree and people may not agree. I think one of the very good examples is actually the breakout of telecom. Again, for those who remember, the Axiata you have today was formerly a part of telecom, right? They were actually under one umbrella, under telecom. In 20, let me get my years plus minus correct. In 201617, plus minus 1617, right? Then the CEO of telecom thought of the brilliant idea to actually demerge, where they actually park all the mobile out of and create the Axiata. So that time they called TM International. Means all the mobile businesses actually park under what you see as Axiata today, and whatever fixed line is actually maintained as the telecom you see today, right? So the breakup was, to a certain extent, you look at in terms of share price performance, total return basis, it actually creates value in that sense, where how they did it was, if you own telecom, you end up with shares of telecom at Axiata, right? So that's how the breakup was being done. But on the long-term implication was, on a business perspective, it's actually not a very smart move to a certain extent. For those who have followed my talk about telecommunication and 5G, I think I've mentioned that to a certain extent, the future actually belongs to whoever that owns the fiber. So because of the breakup, if you think about it, right, had Celcom been a part of telecom, Celcom would have been the only mobile player which also has a very strong fiber optic backbone on that. And if you compare with Maxis and Digi, which they don't have any significant fiber optics, right, you will actually put Celcom in a very strong position as a very dominant mobile player. But because of a very short-term decision to actually break up Axiata and TM, yes, you get a very good uplift in the share price as a total return, but the business dynamic changes in that sense, where what could have been Celcom's competitive advantage over the other players, they lost it. They lost that. Yeah. So these are generally three broad categories of where you actually find value traps in that sense for investors. So over to Vanny, I think, yeah, that's three.
All right. So the second part, because you talk about some of the prices are trading below the NAV, and you talk about properties, right? The property sector. Are there any sectors that are like that has this same similarity?
Property. I mean, other than property.
Other than property, yeah.
Other than property. Okay, another potential value trap, which is quite similar property, is companies where they hold a lot of cash and they're not doing anything with it. Okay, don't get me wrong. I always like companies to hold a lot of cash, but if a company is sitting at a lot of cash, but they are not doing anything to cash, mean to say they are not rewarding a portion to reward the shareholders, neither are they doing it to expand their business operation, or neither they are doing it to actually do M&A or to expand, to buy up, that can also be a value trap in that sense. So if you look at, sometimes you get too excited in the sense we found a company with a lot of net cash, right? And the net cash is a big chunk of their market cap, market value. So we think, oh, this is really undervalued. I mean, I myself gone through that a lot. But I think what the more important question next is, what is the plan of the cash? If the company got no plan of the cash, you just feel very comfortable, I just want to sit on this cash, I just feel comfortable with it, then again, it's going to be a value trap, because you as an investor, or you as a minority investor, you won't get to a part of the cash. Either you won't get it as a dividend, or you even won't get it as a growth, because the company wouldn't be expanding on that cash.
Okay. What about plantation companies? This is from Shamin Rahman.
Plantation company, usually people wouldn't value them on a price to book basis. Plantation company are still more earnings perspective, right? So they don't really go and value how much is this land bank hectareage is worth. This is where a very sad part. I mean, it's just, again, it's a personal opinion. I must qualify myself, right? You see, a plantation is a continuous revenue generating business, right? I mean, the trees, after 20 years you can plant, it continues. But unfortunately, for a lot of planters, it's too slow a profit. They are profitable, but to them it's too slow. So a faster way, what they do is they just cut off all the trees and build something there, become property developers. That's why very conveniently, right, you notice that a lot of planters, I call them planters, plantation companies, they convert themselves to property development, because it's a much faster way to earn money, right? You chop off all the tree, you build something, your GDV is a few hundred million. If you rely on the tree to bear the FFB, it takes you many years before you can earn that amount. But I think for me, I look at it on more of a more than just an economic basis. I think more of a sustainable basis, right? A tree continues to bear revenue on the long term. Once you do a property development, once you set up that community, it's full stop. You know that there's really no more earnings coming from that land bank. Of course, we may argue that we need houses, we need whatnot. Yes, it's true, but don't forget, you know, there's a massive oversupply in Malaysia, right? Due to all this chopping off of trees.
Okay, there's a question here from Pat Dennis. Can we still base on NTA to estimate the value of a company?
This is very interesting. See, the only thing about NTA, again, you need to look at a few questions or a few perspectives you need to answer. The first thing is NTA, right? What is the TA? What is, okay, net tangible asset? The first thing you ask yourself is, what is the tangible asset? Right. If intangible asset is things like machineries, take machineries for instance. If a big chunk of it are machineries, right? Then, sorry, can you hear me?
Sorry, yeah, now it's okay now. Just now it was.
Is it okay now?
Yeah.
Now it's really DJ's fault. Okay. If a lot of the assets are actually machineries, right, then you need to put a lot of discount to the machineries, because if the company were to go into see net tangible asset analysis is to look at if the company will look at the liquidating value. If the business were to fold up when they sell off all the assets, are you getting a higher value than the current market price? So the only time we look at NTA is on a liquidating basis. So if a lot of your assets are actually machineries, whatever is reported there in the book wouldn't worth as much during a liquidation process. Most likely, on the rule of thumb, you look at Benjamin Graham's classic security analysis, right? He will only attribute 20% of the value to machineries during liquidation, because machineries don't worth a lot during liquidation, right? So you have to look at what actually is the NTA. Okay, for banks, why people like to use price to book to analyze bank? Because you look at bank's asset, right? They are mainly cash, right? Your deposit, all this cash. Bank is a cash business, right? It's your deposits and your loans, and these are really, really liquid assets, very, very liquid assets. So that's why for banks, you are able to use price to book, because the book is the tangible asset, which is it's the asset which is cash. I mean, that is as close to that as possible. So there is no yes or no. I think what is more important is what is the asset you're talking about to analyze that company. Yeah.
All right. Okay, there's a question here from Stephen Patrick, since we are on the topic of NAV, net asset value. So if a closed-end fund that trades below or discount the NAV, is it a profitable value fund as well? That's a very tricky.
You guys are trying to get me into trouble, is it?
Yeah, because actually he asked directly just now. I think another guy, but now so generally, let's not just talk about the Malaysian closed-end fund, but closed-end fund is general. Because sometimes the prices are trading below the NAV, right? But there's a reason why it's trading below the NAV, especially as a closed-end fund, right? So do you think that would provide a value trap as well?
There's a few answers to that. Actually, closed-end fund is a very closed-end fund is one of the oldest structure of collective investment scheme. Actually, closed-end fund existed much earlier than unit trust. So it's actually a very, very long existing product. Although Malaysia technically only have one closed-end fund, if you look at globally, right, closed-end fund is very, very huge. And you believe it or not, there's still closed-end fund being launched even now. It's closed-end fund in total, I can't remember the exact number, but the total closed-end fund is in trillions globally. It's a very big investment scheme in that sense. Generally, again, we need to separate between two types. Okay, closed-end funds to a certain extent trade at the discount. I think the only question is what is the size of the discount. So globally, whenever a closed-end fund trade at quite a big discount, what usually happens is that you have all these activists, you actually buy a stake, and they'll actually force the fund to close down. Because as the fund closes down, you get to realize close to what the NAV is. So that has been the modus operandi of global activists to actually ensure that the funds don't trade at a very big discount. Because once it trades at a big discount, there is opportunity for them to make extraordinary gain. If you just think about it, if the closed-end fund is worth $1, the NAV is $1 and trade at 70 cents, for instance, right? So imagine if you're activist, you go and buy at 70 cents, you force it to close down. So even like it doesn't, by the time you dispose, it may not be 1 ringgit, say it goes up to 95 cents. So imagine you're earning 25 cents out of 70 cents. So that again, that is quite a 30 to 40% kind of return on that basis. So that is our idea. But globally, how does closed-end fund manage the discount is, again, if you go and do a survey, closed-end fund that pays a dividend actually have a narrower discount than the closed-end fund that does not pay dividend. So one of the methods where global closed-end funds, they try to manage the discount is they give dividend. Because if you continue to give dividend, if the discount is very big, your dividend yield actually goes very high. So automatically the discount will narrow simply because of dividend yield. Yeah. So I'm talking about global closed-end funds. I'm not talking about Malaysian closed-end funds. Yeah.
Okay, this one is a little bit off today's topic. There's actually a question earlier. This is for you, Peter, right? Do you agree on the buy on rumor, sell on news?
I don't. I don't believe in investing on rumors. I'm not sure if I shared this hierarchy before, right? You see, even the time when we are a fund manager, right? You assume that we are very, very close to the information source, that we will actually be very close to getting any first-hand information, right? Unfortunately, I tell you that's actually not true. Even by see how the actual flow is, if there's any material development, right? Okay, I mean, let's talk about reality. This is pure, honest reality, right? If there's any significant development, the company owners and families will know first, right? Then the second will be their friends who know first. Then the third will only their friends will know first. So by the reality is, by the time the news reach even us as a fund manager managing funds, we are already quite late when the news comes to us already. We can see the share price already reacted. So can you imagine, right? When it reach fund managers is already quite at the last stage. Can you imagine what happens when the news flows to the retail investors? You see what I'm trying to say? Unless the only differences is if the fund manager belongs to the close circle of the owner, then of course the fund manager will get a very, very early news. But if you just take an average fund manager like me, I'm very bad at socializing. Even when the news come to my stage, you have seen the share price going up 30, 40% already. So can you imagine, by the time it reach you retailers, it's the end of any rally that you are going to see.
So
yeah. Sorry. Just like you notice, right? For any project, you notice it's a very common trend, right? Whenever a company announces that they have won a project, you have noticed that even before that announcement, the share price will have gone up, and by the time they announce it, the share price will have corrected. I think that you have seen a lot of such scenarios, right?
Yeah. Because I mean, as a guy who look at prices, we always believe price discounts the news, lah. That's what we believe, lah.
Yeah. Correct.
So that being said, because there's also a question earlier, because you're talking about glove makers, right? They have been making news again in the past few days. These prices are all gone up like crazy in the past few days, right? So what do you think about the rally in? Is it really because of there's really a good prospect, or is it just purely speculation currently going on?
Yeah, let's be very realistic. I think when ET we start to actually launch education on glove, I wouldn't say promote glove stock. You're not allowed to promote, but for our members that I think who have been following us, we even started to highlight about glove sector in December. And of course, before the lockdown, we actually invited Tok Glove Chongwan to actually brief our members about the glove industry. And that time, if you look at it, I think Supermax was barely 1 ringgit 50 cents, 60 cents. So for Supermax, I think Third Glove was barely 6 ringgit, 5 ringgit plus ish, right? I mean that was where you're looking for. So at that time, it's a very easy decision to make, right? The valuation is cheap and fast forward, if you look at where we are now, Top Glove is close to $9, right? Supermax, I think, is close to $4 to a certain extent, right? Is there still value? I mean, if I look at a very simple perspective, on average, they're trading close to 40 to 50 times PE valuation. For it to drop down to 25 times PE valuation, or the historical norm is around 30, right? Let's say they take some discount. For it to fall back to a natural long-term average of, say, 25 to 30 times PE, right? The profit need to double from where it is today. So it really depends on your perspective. Do you think that are they able to actually double in terms of profit? Now, of course, if you think that they can, then of course, then it looks cheap. But if you're in the camp that you think that at this size, even as much glove as needed, as much pricing power there is now, if you don't think that their profit are not able to double, then of course it's not cheap. Because even if it doubles, it's only bringing the PE to 25 to 30 times range, not to a single digit range or even not to a 10 times or 50 times range. So at doubling of profit, you're only bringing down to 25 to 30 times PE range. So you, as an investor, you have to be comfortable yourself. What do you think will be the likely of the possibility that is going to happen of doubling of profit scenario?
All right. Now, there's a question here from Wong Ki Ding. If a company's other income is more than the core income, do we need to subscribe the other income to value?
Okay, that it depends on where the other income comes from. You see, when you value a company, that it really depends on what is your intention when you invest in the company. If your intention is that you like the core business, then in your analysis you should discount the other income. But then again, it really depends on what falls under the other income. Right? If the other income belongs to FD, where it's quite a certain or money market fund, then of course there is a big certainty of that return. Then yes, it's quite stable. But some companies, they actually allocate a part of their fund to other fund managers to manage, so that other income can be volatile as it depends on market condition. So then it's very hard for you to project what that number is. But then on the other hand, right, assuming that is the second scenario, shouldn't the company actually, rather than holding that cash to earn the other income, I mean, would it be better off to use that cash to either expand the business, or if they don't need the cash, would it be better for it to divvy out to shareholders, back to shareholders to do something about it? Right. So it really depends on what is the other income we're talking about.
All right. Okay, so we have another question here from Shamin Rahman. How do you value a cyclical stock?
Let's get the reality right. Actually, every business is cyclical. It sounds weird, right? But every business is cyclical. The only difference is whether is it a long cycle or a short cycle. You see where I'm coming from? So every business there is a cycle to every business. The only difference is you're talking about a few month cycle, or talking about a yearly cycle, or talking about a 3-year cycle, right? So they are all cyclical. So it doesn't really change. But of course, if you're talking about very short-term cyclical, right, the thing can fluctuate a lot. Then you have to be very, very careful. I mean, there's really nothing much to do on that basis, as far as your eyes can see, or as far as you are able to project that. Yeah.
Okay, there was one question here from our ET Online campus. How to identify off-balance sheet financial instruments as required in KLSE quarterly financial reporting?
Wow, very difficult. Very difficult. I mean, if you really ask me, right, no offense to the accountants out there. Technically, I'm also accountant. I hold a chartered accountant, but no offense. I hope I don't lose my license for this. I think accounting standards have gone up to a very ridiculous level, where most of the new accounting standards or accounting rule doesn't make sense at all, to be very, very honest with you. What initially more reflective income statement and reflective balance sheet, because of all these new IFRS that come around, it actually makes whatever income statement or balance sheet to be less valuable, in the sense that it totally distorts the whole picture of what a company should be. That's the unfortunate part about accounting rules and accounting standards.
All right,
sorry,
so...
I don't...
I think ACC is going to come and look for you.
MIA.
Okay, guys, so we keep on asking your questions, but before that, I'm just going to make a few announcements before we continue today's session. So again, for those who are new to our Investors Copy Time, please like our Facebook page and follow us so that you can get notifications on our live sessions. All right. So make sure that the notification is on your Facebook page. Right. If you're on YouTube, you can also subscribe to our YouTube page, the Equity Striker YouTube channel over here. Click subscribe, and you should get notification as well. All right. Now, lastly, we also have a package for you guys who wants to keep on following us, all right, and for us to also help you to be a well-informed investor. We have actually come up with a package called a Market Genius package. This is where everybody, we want everybody to be a stock market genius, meaning that you are actually a well-informed investor, rather than looking for information outside, from rumors or from tips, which we don't really believe. And Peter already explained earlier, right? Because we are all data driven. I think that's more important. Okay, so subscribe to our Market Genius program. I'm going to just give me about 2 or 3 minutes to explain to you what's all about. All right. So one of the things that you're going to get in your Market Genius is our Equity Striker platform. Okay, this is where you get financial results, from the financial data for all listed companies in Bursa Malaysia, so that you can make an in-depth research and analysis on these companies. All right, like Michael mentioned, like Peter mentioned earlier, there are actually quite a number that you can learn as well. And this complements very well with our ET online campus, because that's where we're going to teach you how to look at these figures, right? And how to easily, size up a company in just a few minutes of looking at these numbers. Okay, so we try to make it as simple as possible for everyone to understand. So that's our Equity Striker platform. Okay, and in that Genius package as well, we will also include a portfolio management system, right? This is not any portfolio management system, but this is a very comprehensive portfolio management system for you to keep track of your investments. Right? Sometimes you got a lot of stocks that we bought, but we do not know how they are performing, and how do you adjust them, how do you change them, how do you evaluate them. Okay, this is one of the best tools that you can find in the market currently, and you can't find this anywhere else. All right, so this is what you'll be getting as well, a portfolio management system. Now, apart from that, if you don't know how to build your own portfolio, we will also be giving you 5 different portfolios for you to look at. For you to actually, if you want to follow, you can follow. But remember, this is for educational purposes, right? Because the reason why we build a portfolio is for you to understand how we actually build portfolios, right? Using the methods that we have, that we've been talking about ever since we started even our Investors Copy Time, right? And also those who at our ET online campus. This will also be a good way to actually start off your portfolio, right? So this is where you have 5 different portfolios. We have a 10,000 portfolio. You even have a 50,000 ringgit Sharia portfolio for our Muslim friends. All right. So if you want to build a Sharia-based portfolio, we also have a sample there. Okay. Now, we also give in the package. We also give our research, because every month we also actually have a research where we actually write in-depth analysis of companies that we think that has value, right? And of course, we also have our club meetings where you are able to join us online as well, right? Like Peter mentioned earlier, we had Top Glove, and then we had companies Motion VTech, right? And recently, Peter, talked about the semiconductor industry itself, right? So all of these insights are available exclusively to our members and those who subscribe to the Genius package. All right, so this is all you'll be getting. So how much it is only 200 ringgit a month, where you get all those I've just mentioned. All right, and if you pay for 2,000, if you pay for 1 year in advance, that's 200 ringgit a month. All right, so you pay 2,004, and if you think that you don't want to commit too long, you can also subscribe on a monthly basis, and the monthly subscription is actually 240 ringgit a month. Okay, please bear in mind that the prices here does not include SST, right? So if you think that what we have provided to you so far, it has some value to you, hope that you are able to continue to join us, because once you get all these tools, then whatever that we discuss here will make even more sense to you guys. All right, so to get this package, all you need to do is to just go to equitystriker.com/free. That's where you are able to see the rest of the details, right? Now, if you want to have more details, you can also WhatsApp us with the number that I provided you earlier, which is 603-8408-2070. This number is also pinned to the comment right now. So if you want to find that number, you can call that number. You can also WhatsApp the number to find more information. All right. So if you want to give it a trial, just access to this website, equitystriker/free. If you want to try it for 2 weeks, we also provide, but this is only open for those who have not used our platform before. All right. Okay, let's get back to business. Okay, now next question is this is from Charles Tan. This is a quite new question here. Would you look at gearing plainly on its value only, or would you look at the quality of the debt and their repayment source to determine acceptable gearing for a company? So this is nothing to do with today's topic, actually.
I think, okay, again, it depends on the nature of business, right? Say for instance, if you are a very, let's say a very extreme good example, if you are, say, a power plant, you're in the business of a power plant, right? It's crazy to expect anyone to actually use their own cash or their own capital to actually invest in the power plant and expect to earn a return for the next 20 over years. So in this case, for sure that they are going to incur a structure where the debt will match the asset, that they actually have a very structured debt actually coming to support this asset. So if that's the case, right, then it is very natural that to expect there's a gearing on that perspective. Say for instance, if I use on a very extreme example, right? Say for instance, you are a manufacturing company, right? Then you go and launch a bond, right? A 5-year, 10-year bond to actually expand on your business. Then you really need to know what kind of manufacturing you're doing. Then a lot of questions start to arise, right? Because it just doesn't fall into place on that perspective. So gearing again is something very subjective. It really depends on what business you are in, whether is it normal for your business to actually incur gearing to actually support the capex of the operation. I think that is a more important question. Then, of course, once you fulfill that criteria, then only we start to look at, okay, what kind of debts are you being incurred? Are you getting the best deal, the best structure out of it, or are you being shortchanged, or are you paying a much higher rate than what you should? So that actually comes on the second stage perspective.
Yeah. Okay. Okay, there's a question now. This is an accounting question, so this is beyond me, right? So you say you are also. There's this accounting treatment, right? The MFRS 16. Does it affect the value of companies or not?
Be MFRS 16 or whatnot. I think one of the biggest problem started was not even the recent MFRS. Even as far back as, see, the whole accounting fraternity, right, or the whole accounting rule had a very major shake-up after the Enron case way back, I think in the year plus minus Enron 2003. No, even earlier than that, 2000, 2001. So the whole Enron actually shake up the whole accounting fraternity. To sum it up, Enron, which was then supposed to be one of the world's largest energy company, people actually found out actually everything is not real. There's no real asset in the balance sheet. There's really no real thing in the balance sheet. And yet they were at that time the world's largest, so-called supposed to be the world's largest power company in that sense, right? I think that provides a very big shake-up to the investment fraternity. Then the whole investment fraternity becomes so obsessed with trying to actually value things in the balance sheet. So all these new accounting rules is actually me trying to come out to determine what is the real asset, quote-unquote, real asset and liability within balance sheet to prevent another Enron from happening all over again. But if you look at it, all these new MFRS, right? If you look at it, they're trying to put a lot of judgment into the value of how do you value things. Take fair value, for instance, right? It's so arguable actually what is fair value, right? So if you are really a pure accounting concept, I am a very pure basic. I'm not that smart, so I learn only basic. To me, there is nothing more relevant than what is actually your cost, correct? That is the real transacted value, right? Market value comes when you really dispose it. But you are trying to use some fantastic formula to come up what is the fair value of this asset, that asset. So my question to you is, what makes your judgment on or the fair value or the auditor's judgment of fair value more accurate than what the management think what is the fair value? It's arguable, right? What is fair to you may not be fair to me. So I think that the whole concept of accounting rules, be it your list treatment, your deferred tax treatment, and so on and so forth, it's just making your whole balance sheet and your income statement more arguable. and more less reflective of what is the reality of it.
Right. What is, because these are all just accounting treatments, right? How they treat accounting doesn't really reflect the value. So how do you actually so the question I would actually want to save at last is there's also one question earlier that says, so how do you actually value a company? I think we have got this question quite a number of times. Oops, Peter, I think you are.
There's no fixed way of how do you value a company. I'm off again. Okay.
Okay, now you're okay again. You're back again.
Is it better now?
Yeah.
I think the internet knows when I shouldn't answer and when I should answer. So when it's time I shouldn't say something, the internet will go off by itself. If you think, I think the valuation method is really depend on what company or what is the business of the company. There's no fixed valuation method. To value a bank, financial institution, is very different to value a property company, and it's very different to value a manufacturing company, and it's very different to value IT company, and it's very different to value. It's just different businesses have their own way of being valued. So there is really no one size fits all valuation methodology that you can actually just apply across the board and to make your investment decision.
Yeah. So if you guys still asking the question, that means you probably haven't gone to our ET online campus lah. So please join us in our ET online campus. Right, just go to charity.equitystriker.com, charity.equitystriker.com, and get more information from there. All right. So I'm going to leave one more last question from Peter Lim. But there's one question here that from a Facebook user that asks, how long will it take to get added to the ET club on Facebook once you subscribe to the package? Now, once you subscribe to the package, once you made the payment, and so immediately you'll be added to our ET club on Facebook. That's a closed group, right? Only for Genius package and members. All right. Okay. Maybe to sum that up, Peter, I think some of them probably missed a little bit. Maybe you want to just summarize the 3 things that you identified earlier and how to actually avoid value traps.
Yeah. Before that, I think whoever attended the last week club meeting, I think this week so far you don't have complaint. I think things are doing quite well for you after the club meeting. I think, whatever trend we actually shared during the club meeting, I think you're starting to see the result starting from this week, last few days ago. Yeah. So okay, to sum up, I think value trap, based on my category, there's a few areas where value trap can happen. The first, of course, is conglomerate, right? Conglomerate, usually people use the sum of parts, meaning they value parts of the businesses, right? And then they'll sum up totally to say this is some. I think a very good example is like your Boston Holdings, your DRB, HighCom, and your so on and so forth. Whatever company that have multiple businesses. So why I say that is the value trap is sum of part will only be applicable when there is a breakup or when there is a restructuring to unlock the values, right? As long as the company is ongoing as it is, there is no breakup, there's no restructuring. A sum of part will be mainly a theoretical number, right? So if you were to invest based on sum of parts, I think is to me that is like a value trap, because most conglomerates share price will always trade at a discount to their sum of parts. So don't be so excited when you say, oh, the sum of parts is, say for instance, is 1 ringgit. Now the share price is only 60 cents. I'm paying the 40% discount to sum of parts. It is a value trap because it is a norm for conglomerates to trade at a discount to sum of parts. The second, which I think is a value trap, of course, is property companies. Again, a lot of analysts will actually sell you the idea, this company, if you look at the land bank that they have, say for instance, the land bank is worth 2 ringgit per share. Now the share price is only 1 ringgit 20 cents per share. So it's trading at a big discount to the land bank, right? Again, what I'm trying to say is property companies by nature trade at a discount to the land bank that they have. So again, don't be too excited. The range you're talking about is if you are a big guy, like your Marsing, because maybe you trade around 20-30% discount to the value of the land bank. But the smaller guys or the mid-tier or the small-scale property developers, the discount could be as big as 50% to the land bank that they have. So again, don't be so excited to jump in because it's trading at a big discount to the land bank. Yeah. So that again is a second value trap. For me, I think the third is, I would say, is companies where it's a legacy management. I think somebody in the question did ask about legacy management. I think it's those that is being run by families for multiple generation. Not the problem is because once you reach second or third generation, usually the incentive okay. Let's put in a very blunt manner, right? I think they're so comfortable that the incentive to actually create value for shareholders to restructure it, I think, is not there, right? So there is very little incentive for them to actually unlock the whole value of it. That's why you look at a lot of companies in Malaysia where actually, yes, by the second or third generation, very old companies, you can see they have a lot of cash, they have a lot of very valuable land bank, but unfortunately the management are just not doing anything, just let it be. So if you are going to jump in to be excited, this is a very undervalued company that I should be investing in, that's actually potentially could be a value trap. So these are the three areas of value trap which I think investors should be very cautious of.
All right, thank you very much, Peter, for your insights.
Yeah.
Okay, so guys, I think we have come to an end of this today's session. For those who are joining us on ET Online Campus, we have our price chart analysis mentoring session at 10 p.m., which where I'll be going on later on, right? So it's at 10 p.m. And tomorrow we actually have our Crypto Thursday, and we're going to talk about the development of digital assets in Malaysia, all right? And today, interestingly, I've also found a news that one of the biggest financial firm, right? No, not the one of the biggest financial firm, which is JP Morgan, is actually now opening accounts in Bitcoin exchanges. All right, so this is how far it's going, and we want to see where is digital exchange in Malaysia. What's the development on the exchange in Malaysia right now. So tomorrow we're going to have a special guest who is a current corporate lawyer, but also an ex-investment banker. So join us tomorrow at 8 p.m. on a Crypto Thursday. All right. So till then, guys, thank you very much, and thank you for joining us. We have our Mandarin
at
9:15 p.m. And Peter, you'll be there at the Mandarin session as well.
Yeah.
Okay,
yeah,
so
I'll be there also. Wearing the same shirts, with the same background, sitting at the same place.
Yeah, awesome. All right, good night, guys. So thank you again once again for joining us, and have a good evening.
Good night. Thank you.